Welcome to the JordanSellsCincy YouTube channel. Today, we're going to be talking about a different type of lending. In the past, we've talked about just a regular mortgage going through a regular bank, but today we're going to be talking about hard money lending. And today we have a great guest speaker from Sharper Capital Partners, Investor Relations, Grant Smith. Grant, welcome.
Thanks, Jordan. Happy to be here.
Yeah, thank you for being here. This is going to be great value for some people who've never heard of hard money lending, and then potentially if they're looking into flips or investing, but we'll get all into that. So Grant, let's talk about it for those who've never heard of hard money lending. What is a hard money loan?
So traditionally, when you're thinking of a hard money loan, it's a loan predominantly based upon the collateral of the asset. So sometimes people think of hard money as, this is like costly or expensive money, which it can be, but really it is meant to indicate that you're lending on a hard asset. So the collateral is the most important part of the loan as opposed to the borrower of the loan, although that is still important, but particularly looking at the collateral first. The key difference really here between a conventional loan and a hard money loan is that conventional loans are going to get sold off to a secondary market, usually to a larger bank. And while that can also happen with some funds in hard money loans, typically we're talking about private investors who are setting their own criteria. So a conventional loan has to conform to the criteria of a larger bank. That depends on credit score and a bunch of other ratios that I'm not as familiar with, being just a hard money lender. But the hard money side really is indicative of the property and the criteria that we as lenders set for the projects we're willing to take on, and that's really the key difference there.
Got it. I mean, when I was talking to some friends of mine, I kind of just did a poll review of what they thought what a hard money was. I had loan shark, mafia. I had people had no idea what it was. So just a great explanation overall of what a hard money loan is. So you talked about before having a credit score with a regular kind of financing loan. Does credit score matter for a hard money loan?
So when we're looking at a borrower, we're typically looking at, or a borrower in a project, we're typically looking at the criteria in this order, which is character of the borrower, collateral of the asset, capacity of the borrower to perform on the loan, and then credit. The only reason we really look at credit per se, and it's the least important thing on the totem pole for us, is that credit history just tells a story. And we'll pull credit. We have like a $20 fee where you can just pull it from Experian and it just gets sent over to us. So you never actually have to send us your social security number or anything like that. You do it all on your end and then we just get sent a report. But the beauty of a credit report is that we get an understanding of how many lines of credit are out against a borrower, and understanding the financial position of how they've been performing on those lines of credit. It's not a make or break type of thing. There's no minimum credit score for us because a lot of the people we work with are, say, general contractors or people who are running their own business, so they don't have lines of credit that might necessarily or a W-2 job per se that's going to be helping pull up the credit of their application. But we in general are just looking for people that have good credit history, meaning they're making payments on time and things like that.
Right. So that way, that this is going to be a good partner to work with on whatever project that they have going on. And so just to be clear too, like for the business of Sharper Capital Partners, what kind of deals or people you're mostly working with in your business?
Yeah, I mean, the traditional borrower for us is usually someone who, one, either doesn't work a W-2 job, so they are either running their own business, so they're not going to get traditional financing of any kind per se because of that reason. Or number two, they've maxed out their debt to income ratio for traditional financing in some capacity, shape, or form. And they're looking for a loan that's going to be predicated based upon the collateral, which is the asset in the loan, which is really helpful in their situation because they can be creative with their capital stack and not be limited by really the financial position of them as a borrower solely.
Got it. So that's great to know for those if they're looking for different options, like you said, if they maxed out their regular, that debt to income ratio number there. So let's kind of break it down. Like, what is an example of if someone is how would they use a hard money loan?
Right. So a recent loan we did was in Akron, Ohio. And, the borrower came to us, small business owner, again, doesn't have a W-2 job to, go and secure traditional financing based upon. Still has credit history, and we can look at those things. The process generally starts with them either giving us a phone call or reaching out on our website through our loan application, or we bump into them at a local REIT meeting. So one of those three ways we interact with someone, and they come to us and they go, hey, it always starts with, I have a project. Some people do reach out to us before they have a project because they want to understand our terms. But most of the time, they're coming to us with a deal on their plate and they're saying, hey, I need to get this funded. So the borrower came to us and they had a deal. It was a 45K purchase price, and they were buying a deal from, it was formerly a turnkey rental owned by one of the hedge funds that operates here in Ohio. And it worked out such that they had to let go of the property due to some liquidity issues in their portfolio. And so he got it for a steep discount, like 60% of what it had sold for 12 months prior. And so walked the property, he had walked the property, said it was mostly cosmetic. We pulled comps in the area once he provided us the address and some details about the project, like what's the typically what will happen is when they're talking to us, they will either, when they fill out the loan application or they're talking to us over the phone, we'll get information for, hey, what's the address? What's your estimated ARV on this property? How much work does it need? So what are the rehab costs and what's the purchase price? And based on what they tell us, we can typically provide a loan quote just based on that information. And that's kind of our motto is, we will quote you a loan based on what you tell us. And then during the underwriting process, if numbers change, we communicate that change and why we believe that to be so. But as we went through the underwriting process, which, our underwriting process is much faster than what a, conventional lender probably is. Actually, I know it is because that's a strong reason why people work with us, because they need to close deals fast. And so, borrower comes back to us and says, hey, I can schedule time for you to come view the property and perform your underwriting. So before we even do that, we'll typically pull comps and say, hey, the comps look to fit the bill. Let's go up there and view the property. Or if it's far enough away, then we'll get a BPO or some sort of broker type of opinion on the property. And for a fee, like, we'll charge a small $400 fee of that to get us up there, and so we can get professionals in there with us to look at the property. We did all that, got the BPOs done, estimated the rehab costs and validated those. And then really, once we get that information, we start building a file. So that's where we start saying, hey, let's do the credit check. Let's get your entity documentation. Let's get the signed contract of the purchase agreement, and kind of get everything lined up for closing. So typically the underwriting process for us can be done in as little as like 1 to 3 days. And then the actual document collection piece happens just as fast as you need to close. So we're typically closing our loan within 5 to 7 business days, although more time is always better,
Right.
But, that's typically how it works out because there's an urgent need. So come closing, we put capital in the deal. They'll typically come in with some form of a down payment. And if there's construction draws, rehab costs that we're funding, then they will complete the work, submit us receipts, invoices, and we'll send someone out there to view that the work's been completed, and then we'll reimburse them for the work that's been done. We'll repeat this process over the course of 6 to 12 months. It's usually about how long our loans are outstanding. And then when the project's completed, the property sells, we're collecting interest payments along the way, and then we get our principal back. They either refi because they turn it into a rental, or they sell for a profit. And that's how it works. That's how they make money. That's how we make money. And our goal is 100% transparency, speed, so that people can build well. I mean, that's why people are in real estate on the investment side. So
Right. So so that covered a lot, and like there's like 3 minutes of an explanation, but definitely a lot of terms. So starting off, let's go with so you said so let's say someone watches this video and they say, I want to learn more about this. So they call you. And so like let's say they find a project again. So what do they need to have? All the stuff of the comps, the estimated rehab costs? Do you prefer having that up front already, or is this something you kind of go through with a new clientele for a new project?
So when we're working with more experienced investors, typically they understand what we're going to be looking for in advance. But when we're working with new investors, we're very happy to walk through the process of getting a hard money loan, what we're looking at, and making it available, the information available to them so that they know what they need to provide. In a lot of cases, we're kind of piecemealing it together as we get towards closing. But as soon as someone calls out and gives us a phone call, or lets us know about the project they're working on, we can typically issue them a loan quote, and give them a written sheet of terms. And then if they decide they want to move forward, then we just have a checklist of information we need to build in order to get their file completed. So we also have a 24-hour approval checklist on our website where people can just go on and access that checklist to go, hey, I want a hard money loan from this company, or really any hard money lending company, and they can just follow it step by step and get all the information they need lined up front. Most of the stuff they really need is just their company information, and then the other piece of it is just some minor property information and like a construction draw schedule. That's really it.
Yeah, that doesn't sound complicated at all. That's something for, like you said, either a veteran or a newbie. That shouldn't be, that's not requesting a lot at all. So one of the things you talked about briefly too is that, like, so of course the rehab costs, and then like reimbursing, and you're trying to find that ARV, that after repair value. How do you find that number to when you're getting ready? So when you know what you're going to close on, you're pretty close to that after repair value.
Yeah. So the way that we have set up our business is, we focus only on markets that we really understand. So we're lending out in only Ohio-based markets right now. So Cincinnati, Columbus, and Akron, and some of obviously the suburban markets that surround those major cities. And so when we're underwriting properties, we usually have a pretty good idea of, how the area is. And from there, we're making our own estimates quickly over the phone based upon comparable properties in that area, right? So we're just pulling comps like an agent or an appraiser would in determining a value. And then that kind of gives us the tip of the hat to know, hey, this person's ARV is probably a little high or a little low or right on point. And depending on where it's at will depend on how we move forward, or if we adjust our quote prior to moving forward. And from that point on, we're going to go ahead and get a BPO no matter what, because our capital stack is other private investors' capital. So we're raising capital from other investors, and then we're deploying it into these real estate deals. And, it's a conflict of interest per se if I'm just going out and funding deal after deal after deal, because, that's how I make money.
Right.
But what our investors want to see is, they want to see, hey, who's an experienced professional in this market? What's their opinion on both the after repair value and the construction costs needed. So if we can find an agent who also is a GC, which happens actually quite often, we'll find someone who does that, or an agent who's very experienced in working with investors. We'll ask them to perform our BPOs. If not, then we'll just piecemeal it. We'll find a contractor in the area that we have seen perform well on projects in past with investors, and we'll use them during our walkthrough. And then the agent will just have them pull the comps and look at the numbers they provide. And generally they'll do a drive-by or even walk through the property as well with photos. So, we take our underwriting super seriously, and we believe that it's a valuable part of not just protecting ourselves, but also protecting the clients we work with. Not that, the fiduciary ultimately relies on us to be responsible with, the investment property, but we do believe that we can do a lot of the safeguarding if we underwrite well.
Right. And like, it's just like with a real estate agent deal, just like with you in a hard money deal, there's a lot of investing going into not only the individual who's buying the property, but finding out, is this going to be a good deal? Because for the majority part of the deals that you are part of, would you say they're on the more, there's going to need an extensive amount of rehab, or is it more of a cosmetic rehab for a deal for like a clientele that you have?
So the best deals we always see are the ones that require the least amount of work, right?
Sure.
So typically someone will come in and will have light cosmetic work, and someone will just be forced to sell the property. These are generally in nicer suburban areas where there's decent comps for the property. The other area where we honestly have seen people do really well is with fixed to rent loans on cash flowing properties. So they might be in a market that, let's say is it's not a B or A class area, it's that or lower, or it's lower than that. And so these are areas where, properties can be, not in a major structural issue or have major structural problems with them, but they require perhaps, you know, a little more work than someone who's going to try and fix and flip the property to sell would benefit from doing so. So they'll go in, they'll fix the property up, and they'll rent it out. We've done a couple fixed to rent loans as well, which is the same product as a fix and flip loan, except the exit strategy is just to get to refinance out of our loan and into a new one, the Burr method, right? I mean,
Right.
that's what most people are familiar with.
Right. So you kind of talked about two of the loan, and they're trying to refinance. So for you guys at Sharper Capital Partners, how long is a typical hard money loan, and when do they need to pay that off?
A typical hard money loan, it really depends on the exit strategy of the borrower and for the project. So if someone's going to do a is looking to, you know, do something along the lines of a Burr method, right? They're trying to fix a property up and rent it out. We just did one of those in Lancaster, Ohio. Client comes in, acquires the property, and they're looking to based upon the lender that they're working with and what they're looking to have their new loan based off of, which is they're looking to have their new loan based off of the after repair value. So they're going to hold the property for 6 months, and then they're going to refinance out of that property. Which for us, right, writing a 6 month loan for someone who's going to hold the property for at least 6 months doesn't work. So typically, what we'll do is we'll write a 9 to 12 month loan for something like that. Um, and then for a fix to flip loan, a fix and flip loan, what'll happen is, you know, someone really shouldn't be holding on the property for more than 6 months. If it's going over that, then usually there's a problem either in with the general contractors and subcontractors, or maybe perhaps some of the permitting on the property. So we really like to be in and out of properties, just given obviously how the market continues to shake up. And so a 6 month loan is probably the max we'll do on a fix and flip property, unless some extenuating circumstance changes that.
Got it. Got it. Okay, so that makes sense. So a good time frame to get the job done, but you want to kind of move quickly so that you can kind of get to the next project and the next project, right?
Right. Yeah. The properties that, you know, drag out the longest, or the longer a project drags out, the more likely a borrower is to walk away from servicing the loan altogether and thus the project altogether. And you know, our business is predicated upon repeat clients. So it's extremely important that our clients have success to us, because marketing for clients in our business is expensive, and we want to make sure that we service a growing portfolio of them. And a part of that is making sure that they have success in the projects they do with us. So um, definitely want to keep the projects moving. And that's kind of one of the benefits of working with us is there's a draw schedule in place. Before the project starts, we both have a clear picture of, you know, what's expected of each party, and we're kind of, you know, moving through, you know, the segments of that project on a week to week or month to month basis.
Got it. Got it. And one question, one of the last questions I have here is that just like in real estate, whether you're an agent, you're an inspector, whether or you're a lender, what has been either one of the best or craziest deals outside of your Akron deal you had, but a deal that was memorable, like something you just won't forget being in this business as doing a hard money loan?
You know, we just recently did a deal in Lancaster, Ohio that honestly, I couldn't believe it when I saw it. So it was the client purchased a property that was below market rent. I think they purchased the property for the low 100s and rented it for close to 2 grand or a little bit less than 2 grand. And again, that was even below market rent. And they were able to use what's called cross collateralization, which, you know, is something that's probably a little too advanced for the conversation here. But essentially, what it is instead of using a down payment for that property, so on our loan, right, just on a traditional loan, you're gonna have to come in with 20%, 25% for a down payment, or an
Right.
FHA loan with 3.5 or whatever it may be. And for our loans, we're asking our clients to bring 20% of the purchase price to closing. So instead of doing that, they gave us two properties to secure one loan. That's called cross collateralization. What that means is they owned another property that was free and clear, had no mortgage on it. And so we took that as collateral in addition to the property that the investment property that we were lending on to as well. And so they didn't have to bring a down payment to close. I think altogether, after they got quite a few buyer credits because of the situation. And so they ended up only bringing $217 to closing on this property, and
Wow.
they're break even on the loan that we issued them for now until they get new tenants in there. But yeah, so they acquired their second investment property with us, using for like $217 and then maybe some closing costs. So it was just insane. I was like,
Wow.
this couldn't be, there can't, like, this cash on cash return on something like this has to just be insane on their part. So and not all deals work out like that. Again, these are highlight reels. These aren't the base hits that we do every day. But yeah, there's great deals to be had out there depending on what your capital stack is and what kind of deals you can find. So
Right. So would rather buy a Nintendo Switch or a property? I don't know. You tell me which way you want to do. Well, Grant, this
yeah,
was.
it was.
Oh, go ahead.
Yeah. No, I was just saying it. The one thing I just want to highlight, and I think something to note is, hard money loans are just another part of the capital stack. It's not the only part of, perhaps, like, think of the capital that you're going to use to get into your investment property as layers to a cake. Hard money loans just might be a piece of that. Part of that's the down payment. Part of that might be, a cross collateralization with a property you own free and clear, or it could be, raising other capital from outside investors to help come up with the down payment. So all those strategies and things like that, are worth considering and can be a part of your overall strategy to get into more deals if that's what your goal is for 2023. Just wanted to make sure that's hard money loans aren't the only piece to creative financing; they're just a small part. So
Right, right. And if anyone who wants to be an investor, you need to have as multiple tools in your pocket to see if you can get that property, whether it's traditional financing, hard money loan, or something else. That's something you need to have being an investor. Grant, this has been awesome. Has there been anything that we didn't cover or that you would want to just kind of talk about before we kind of end this here?
no, I mean, for the most part, I think that having the right team in place to help you acquire as many properties as possible, you know, the it's amazing. I talked a lot about how we do our hard money loans, and every hard money lender will do things a little bit differently. So they might offer a higher loan to value. They might calculate their loan to value a little bit more aggressively, or they might just run their whole operation differently with different points and different interest rates. So definitely get out there and network with a bunch of them, figure out which one is the best for you. Just like with an agent, you might have an agent that works well for investors and one that is maybe more retail focused or whatever it may be. And so just getting out there and networking with as many lenders and agents as you can will definitely serve you well in terms of getting the right loan product that you're looking for.
Right, right. Network, whatever, regardless if it's investing, career, just anything, networking is key. So Grant, what is the best way for people to reach out to you at Sharper Capital Partners?
Yeah, the best way to reach out to us is just go to our website at www.sharpercapitalpartners.com. We're on all social media platforms, and you can also reach me via or our team via email at info@sharpercapitalpartners.com. So those are the best ways to get in touch with us.
Perfect. Perfect. We'll put those two down in the description and notes as well. But thank you, Grant. This has been awesome. I think people are getting a lot of value out of this if they never thought about a hard money loan, and if they've never even looked or networked before, this is a great stepping stone for those two.
Yep. Thanks, Jordan. Always
Yep.
great talking to you.
Always. Thank you, Grant. And this is the Jordan Sellscincy YouTube channel. Thank you again for watching, and we'll see you guys on the next one. Thank you.